people who can actually get the grant?
I'm not sure. I wasn't in charge or involved in the actual making, so that's that's Andy and Lauren have been planning that. So I have no idea, but it will be multiple people for sure.
Yeah.
But how many I can't tell you because I don't know how much funding we have. So
yeah. Okay. That's fine.
Just play by ear. Don't fret too much about it. Do your pitch. Do it well. And get so far.
Yeah. Okay. We'll do.
Yeah. Hi, Elena. Hi, Zoe.
How are you?
Good. How are you?
Good.
Perfect. Right. I think we're probably as much as we're going to get today in terms of numbers. So some people had to already cancel because of other, obviously, it's in the middle of the day. I understand this, but it's not going to be 4 hours like some of our boot camps usually are. So this is just a 2-hour intensive kind of workshop. Some of the content, especially Elena, because you were there last week at the business finance boot camp, which was a 4-hour session, but that so some of it there's a little bit of a overlap, but just slightly, and I'm going to go hopefully into a little bit more in depth in some of these things. But well, first of all, welcome. Obviously, bookkeeping, like I said just before, it's not the most sexiest topic that anybody wants to think about, but it's unfortunately, one of the most crucial things that you do have to work on or rely on. So let's see where we get to. First of all, welcome. So this is the team. Anybody who doesn't know us yet or has joined us today for the very first time, we are a team of 6 people now. Andy, the upper row of this team chart is they are all permanent staff now. So we've grown up to 4 permanent staff. Alexa and Lauren are both enterprise officers. Andy's our head of startup and Christian our enterprise assistant. And then we have entrepreneurs and residents, myself, Magdalena. I'm in 2 days a week helping and supporting the Essex startup team. And I've been doing that now for about 3.5 years. So quite a long time, but I just absolutely love it. And then there's James, who's also entrepreneur in residence and usually in on a Wednesday. And unfortunately today he couldn't be part of this. Normally he and I are sort of the numbers people. So we ran the business workshop last week. Yeah. Right. So get involved. Please turn your cameras on if you can. Obviously, some of you have already engaged, and feel free to, also turn on your mics and ask any kind of questions. I'm just hearing there's a lot of commotion outside. May I just quickly look what's going on? Sorry, I'm just running a workshop. Yeah, this is mine. That's yours? Yeah. Well, basically, this car here, yeah. She was just pulling in, and as she was pulling in and rolling forward, she's actually bounced off your bumper, reversed, back of the car walked off. Okay, thank you for that. Right, and then she pulled in, and she got really close, and then she literally just went like that, bounced off your bumper, reversed, got out, and she just walked off. All right, thank you so much. Right, I will write it down. This one here, yeah? Yeah, all right, thank you. Massively apologize for that, but somebody just basically ran into my car outside and walked off. So, but anyways, let's get on with this workshop. I will sort this out in a second and now break. Right, today's agenda. So first of all, we're going to talk about bookkeeping, like I said, what it actually is, why does it so matter? We're going to talk about accounting and accounting methods, also in relation to your legal entities. And we're going to talk about your sort of management accounting, like the most important statements that we're going to look at. We're going to talk about very briefly about forecasting, and then we're going to dive into some accounting tools and a little bit more in depth. We talked about it briefly last week, the profit first system, but I'm going to talk a little bit more about this because from an accountancy level and from a bookkeeping level, this is quite a crucial system that we really recommend. And then at the very end, I'm going to talk a little bit about my own real life example experience as I started off as a sole trader, turned into a limited company, and I implemented the profit first system at the same time, and how sort of that whole worked. So I just want to give you a little bit of an example. And then we can close. I'm not sure whether I'm going to fill the whole 2 hours. I have no idea whether this is going to be enough, but if we obviously close early, then we close early. That's absolutely fine. If you have any questions at any point, please do ask away and interrupt me, and then we can answer them. Right, so in general, just on the business finance, it's kind of the overarching topic. So business finance is, anything that has to do with your financials, your funding, your sourcing finance, but also how to control it then. That's your accountancy kind of type thing. And then how it goes further into how to leverage your finance. And as with everything, it's very important that you kind of understand where finance comes in, business finances, your accountancy comes in, and where your bookkeeping sits within that. And like I said, it's the triad of the financial bliss is the obtaining your finance. That's kind of the sourcing of it all. And then it's going into the controlling of the finance, the management, and then also the leveraging and exploiting of the finance. All of that together, obviously, is your financial business finances. But today, we're going to just talk about the controlling part. So that's more about how to manage your finances. Hi, Krishna. Welcome. So why is it so important? So management accounting, the whole control of your finances is like everything in business. You kind of need to understand how you can manage all your your money, because you need to, run your operations efficiently, effectively, in general, streamline it so that you know exactly what costs you are incurring, what revenues you're incurring, and how it all works together. It's like a cog in a big, well-oiled machine that is your business. So the cycle of accounting and controlling your finances is that first of all, you planning and monitoring. That's where also the bookkeeping comes in. You have your forecasting, you kind of look in the future on your past and current experiences. You kind of make a prediction of how your sales and costs are going to go in the future. You then have to regularly do some reporting, and that again is the accountancy side of things. And then you also have to analyze that reporting, so you kind of know where you stand at any point in time, and make managerial decisions based on that, and then it goes back into your planning and monitoring because of those decision-making processes that you've done in the analysis stage. You then might change your profit margin, you might change your costs, you might try to find frugal ways to save some costs or make more money in general. So why bookkeeping? So bookkeeping obviously is part of that whole equation, and bookkeeping as a definition part is the recording of your financial transaction, and it's part of the process that you need to do as a business, and it's part of your accounting. So it involves preparing your source documents for all transactions, operations, and other events of a business. That's just really the straightforward definition. But what is accounting versus bookkeeping? A lot of people use these terms very interchangeably, and also use these terms almost one instead of the other, or it's not really sometimes not clear what they mean. But overall, the accounting side of things, that is your overarching, and your bookkeeping sits within your accounting. So the bookkeeping is like the first part of your accounting, because that's the actual timely mannered transaction-based recording of your transaction, and that's within the accounting. The accounting, on the other hand, is the looking at those transactions, running reports from them, analyzing your all of those reports, and kind of making decisions, as well as looking at your profits, looking at like just the interpretation of all of those things. That's your accounting. But the bookkeeping is the first step of that, to actually record things. Hope that makes sense. So when we look back on this, you will see, so like I said, the planning, the monitoring, that's kind of where your bookkeeping sits. But everything else, the entire cycle, that's your accounting. Did that make sense? Any questions on that already? Or anything? No. Cool. Then we're going to go a little bit into accounting methods. So there are two major accounting methods, which are the cash accounting and the accrual accounting. And the only difference between the two really is the time when you are recording something. So for the cash accounting, you record an income or an expense when the cash leaves your bank account or when the cash comes into your bank account. That's cash accounting, quite straightforward. Accrual accounting, on the other hand, is when you record the income or the expense when you actually issue the invoice or receive the supplier's invoice. So, so that's it might just be a few days. In the difference might just be a few days when you get the income in versus when you raise your invoice. But sometimes it can be also 30 days. So for example, the university has payment terms of 30 days. So when I raise my invoice to the university, I have to account for 30 days wait. So in accrual accounting, I account for the invoice though at the date I sent the invoice out, I issue the invoice. Whereas in cash accounting, I would record that transaction when the university actually would pay me. Did that make sense? And the difference? And it becomes relevant because it depends on your legal entity, at least in the UK. I think in some other countries, it might be different, especially in the US. I think accrual counting is much more used there in any kind of legal entity. But here it is sort of still a little bit up to you. So when you're a sole trader or a sole trader partnership, you have the choice between cash or accrual accounting. Also, if your turnover is less than £150,000 a year, you also still have that choice. However, if you are a limited liability company, for example, a private one, you have to do accrual accounting. And the same if you're in turnover, regardless which legal entity you are, your turnover is over 300,000 a year, you also have to do accrual accounting. But please, 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 on any of these and exactly what you have to do your research and talk to a professional accountant. We are not accountants. We can just give you this as a guidance, but you need to do your own research and really need to talk to a professional chartered accountant in the country that you are starting to trade. So if you do start to trade in the UK, then please talk to an accountant what you exactly need to do. But as of this date, as I could find at least online on the government website, etc., this is kind of roughly an overview of where cash accounting versus accrual accounting takes place. And this is really important for your bookkeeping because, again, you have to, the date you record something is very crucial. So you have to kind of know the difference and make sure that you are in line with what you legally have to, depending on your legal entity. Yeah. Right. I'm whizzing through this, so we might actually finish really early. I know this is not bookkeeping per se, but this is obviously part of that. So when you run reports, especially at your year end, you have these three major statements that you usually have to run. Some of which you have to actually also, if you are a limited liability company, then you have to submit these potentially also to Companies House, upload them, or your accountant does that for you, whichever way. But these are the three main statements. You have and also overall arching financial statements are therefore, they're there to really understand your financial health and how you are performing. So the very first financial statement, well, I look at them in different order than it's on here, but the very first one is kind of your income statement, which is the same as a profit and loss statement. I look at the balance sheet. That one, for example, when you look at companies on Companies House, all you see is their balance sheet. So you never see their P&L or that's the short for profit and loss statement, or your income statement, or you don't see any cash flow statements, but you do see a balance sheet. And I will explain a little bit how you see the difference. If you were attending last week's workshop, you got the same information. So this is just a little bit of a overlap, but I think it's really, really important to understand these, because that's where your bookkeeping kind of leads into. And then when you run these reports, you need to understand what you're looking at in order to make your analysis and to make those performance decisions later on. In general, like I said, the financial statements, they are good for you internally, because you kind of check whether your growth is on track, whether you have enough cash, which is obviously really, really important, because one of the main reasons why businesses fail is cash flow. They're running out of cash. So you always have to make sure you have enough cash and cash means also could also be tied into assets, but not long-term assets. They have to be assets that can be sold super quickly and turned into cash. Though those kind of assets can also count into your cash flows, but long-term assets like properties or anything long-term, I guess, I don't even know what other long-term, but properties or plant and machineries, those ones you can't sell as quickly. So they are long-term assets and therefore they wouldn't come into your cash flows. But yeah, so cash is super, super important. And in general, managing your resources is really important. So you need to run these report to see internally how you're doing. Externally, they kind of give also a lot of information to investors, you know, whether you're good investment, if they want to invest in you, you know, how you're managing your assets, on whether there's anything, you know, flagging up. Okay, the very first one is the profit and loss statement, also known as the income statement. This is, to me, is like the first one I ever look at. And it's the easiest and kind of most basic financial statement. But it's because it just simply summarizes all your revenues, all your turnover, everything that you made in terms of money, all your sales, if you got an investment in anything that makes money. And then you put it against anything that went out of your business, any your liabilities. So anything in terms of expenses that are, all of which is incurred in a specific time period. So usually you do this at the end of the year, accounting year. So again, your financial year might differ. If you're a limited liability company, your financial year might differ to the tax year that is from the UK. So in the UK, the tax year usually is from the 6th of April to the 5th of April. So 1 year. If you're a sole trader, then that's your that's also your kind of company year. If you're a limited liability company, you have a financial year from the 1st of January, you could have it from the 31st of March, you could have it from any point in time. And sometimes, like my accountant always told me, it's actually beneficial to have a little bit of an offset to the general tax year, because you can kind of push some of your dividend payments and things like that in different ways. But that's on a very high level. That is more advanced accounting. So talk to your accountant if you're unsure when to set your business up, or if you already have one, then that's how you just roll with it. A lot of people just go with the tax year because it's just easier. Because as a limited liability company, you have to run a company's tax. So you have a corporation tax. That's one set of accounts, but you also have yourself as a director of your company, and that's a self-assessment. So that you have to, so basically you run 2 tax statements, whereas if you're a sole trader, you only do 1, which is the self-assessment, which is always 6th of April to the 5th of April. Right, but the profit and loss statement, AKA P&L. So if anybody ever talks to you like, where's your P&L? That's what they talk about. I always find it's very throwaway, like P&L, just sounds very fun. But anyways, it's also known as the income statement. So they are exactly one and the same. So last week we had, I've run a glossary quiz, and one of the questions was whether they are the same. And I think a couple weren't sure, and therefore, yes, they are exactly the same. It's just a different name. And like I said before, so you really literally run record your revenue and your AKA your sales, and you subtract your expenses, and you're going to see the net income at the end. This is before tax though. So that is then the number that you would calculate the tax from. And then you obviously subtract even the tax from that. and then you have your actual profit at the end. All of this is, like I said, over a period of time, so it has to always be one point in time, and it makes sense if you do it at the end of the year, at the end of your financial year, to always do it at the same time, so you can actually analyze the progress, so you can actually look at them next side by side and see how they're doing. And again, why is this important? Well, because you're making money and you kind of need to see that, and if you're not making enough money, then you need to see the same. So that's why it's profit or a loss. I mean, obviously there could be a negative number down at the bottom as well. You need to kind of see where is the bulk of your expenses, and maybe you're overpaying something. You could then kind of make decisions around, where could I be more frugal and save some costs. But you can also see like which are your most successful services and products, and you can also see just general if you are very profitable at the end, so your bottom line is very in a good position, then people might think you're very healthy. Although the profit and loss statement isn't the only statement that people need to look at when they talk about the health of your business, because that's also cash flow plays a lot of into that, but also your balance sheet. But yeah, so the phrase bottom line comes from this statement. If you ever heard the phrase bottom line.
I have a question.
Yeah.
So this is actually the sales, actual sales that's happening. So isn't it pretty much the same as accrual accounting, because the cash may not be in, which is the cash flow, but this is the sale reporting of actual sales. So I sold something today and I raised an invoice, but the money could be coming in 45 days or 4 days from now. So isn't this actually a reflection of the actual sales, not the cash per se?
It depends which accounting method you're using. If you're using cash account, for example, if you are a sole trader and you're using cash accounting, your profit and loss would be recording the cash. So it wouldn't record on the date of the income, the invoice being raised. It would record from the date of when the income comes in. So if, for example, so you have it both ways, but you need to kind of choose one or the other. You can't have both. But yes, it would be a reflection of whichever accounting method you're using, that would be reflected on here. So if you, for example, also so let's say for argument's sake, your financial year goes from the 1st of January to the 31st of December, then you're raising an invoice on the 31st of December in accrual accounting, that would be included in this statement. In cash accounting, it wouldn't, because the actual cash would be received on the 31st of January the next year. So that would come into next year's profit and loss statement. Obviously, you can run the profit and loss statement depending on which accounting system you're using. You can run it at any point in time. So you can run it every month, you can run it in the middle of the month, it's up to you. But it makes sense to do it always at a very similar stage to really know where, like, to make the comparison for the previous accountancy period. But you can run it at any time to just see where you are. Maybe you can even run a monthly detailed one if you're using a software, because then you can really see how it's month by month, how it's going. Yeah. Okay.
If a client defaults on their payments, how is this resolved in accrual accounting?
Sorry, again?
If a client defaults on their payments, how is this resolved in accrual accounting if it's already been recorded?
That's a very detailed question. Normally it goes into, if you haven't actually received it yet. So if you're doing accrual accounting and you haven't actually received something yet at the end of your financial year, and you run your reports at the end of your financial year, it would go into your accounts receivable. So it's to be received in the future, and that will come on your balance sheet. We will talk about balance sheet in a second.
Okay.
If it can't be, if it's then defaulted, so it's not being paid, then
Yeah.
at some point you would probably run a credit note because you've raised an invoice, so you have an invoice number on it, so you have to create a credit note for it, etc., etc. So it's a very detailed question. Probably
Right.
best to talk to your accountant on that.
Okay.
Yeah, but at least, you know, I mean, it will come into, if some, I will show you in the balance sheet what I mean with accounts receivable in a second, and then hopefully that makes a little bit more sense. This is just a very simple overview of how a P&L could look like. So literally you have your revenues on the top. The cost of sales, I didn't mention that before. The cost of sales are also expenses, but they are separated in a P&L statement because they relate to, so these are costs that are relating directly to every single sale you're making. So if you're selling a product that is made out of wood and, you know, whatever materials it's made of, those materials would fall under cost of sales. So they're not just general expenses to run your business, they are actually per sale, per item you're making certain amount of costs, so that they would run under this. So also known sometimes as cost of goods sold, so COGS. A lot of people use that phrase as well. But yeah, literally it is any purchases that you have to make in order to perform your sales. So for example, again, in my photography business, it used to be I shot the weddings, and then I would do my editing and all that stuff. And then they would receive a little wooden USB stick with my logo on and a wooden box with some prints on it. The prints itself would be cost of goods sales. The box and the USB sticks would all be cost of goods sales. Cost of goods sold, sorry, cost of sales. Because they go alongside every single booking I was doing, every single wedding I was doing, or any single shoot I was doing. So that would be recorded under here because they kind of immediately relate to that revenue that you're doing. That's why it's separate. They are essentially they are an expense at the end of the day, but it's just how the gross profit always gets revenues minus cost of goods sold. And that's your gross profit. And then your expenses come in, and then any kind of banking fees and banking like charge or anything of that. And then you have your net profit, but this is still before tax. So it's not really, I don't like to call it net profit because people confuse it then, because you would then still subtract your taxes to really have your proper profit or loss in that sense. Yeah, any questions on the P&L before I move on?
The COGS is just the cost of sales. I mean, it doesn't, what would it, because it would also probably comprise expenses, right? I mean, if you bought the USB stick, it would come as office supplies, maybe. And it also could reflect in cost of sales. I'm a bit confused because the wooden box that you would have bought, that would also be part of your expenses. How do you exclude that? How do you refine the COGS?
You refine it by, so in my package, this is very dependent on your products and services. But in my package, a USB stick would always come with the sales. So it would always be part of that, making that booking. It's not a general office supplies because I'm not buying in a bunch of branded USB sticks I give out at marketing, like at fairs, or send out for marketing material. Then it would be an office supply potentially, or marketing cost in that sense. But because I use it as it's an item that literally is one-on-one, goes to, I make a booking for a wedding, I deliver that wedding, and that is part of that delivery. That's why it would fall under cost of sales and not under general office supply expenses. Did that make sense?
Yes, thank you.
If you're printing a lot of flyers and things like that, for example, that would be general marketing cost. But if you're printing specific flyers or specific greeting cards that go along with, or thank you cards that go along with the product that you sold. So it's a lot of times, like I bought, for example, I bought the like a planner the other day, well, at the beginning of the year, and that was shipped in a nice, super nice package, and had a thank you card and had tissue paper and all of that stuff. That all of that package is a cost of sales for that business, because they made this sale, but all of that to sell it also comes along with a box, a really beautiful box. You know, it wasn't just a general packaging box. It was a specific box for this particular sale, and so on and so on. So I mean, there are some things, probably like the tissue paper, you buy it in bulk anyways, and so it could be a general expense, because you might also package other things with it. But normally all of that, I would put it under cost of sales, and that's how I learned it. But if you are having an item in question, always good to talk to your accountant quickly about it.
Yeah, sure. Also, the beginning inventory is part of COGS. Like beginning inventory is the expenses that you have incurred for buying stuff.
In this case, I think it's, yeah, I'm not 100% sure how this would work here. It's not declared as a negative number, so it's not red. It's the it's what it's probably already been in the office from last year's P&L. So that's so it's basically the cost of, so if you bought tons of stuff in bulk, you account for it in the 1 year, but you still have left over for the next year, and that's your beginning inventory for the next year. So that's why it's not an expense here, because it's still it's already been paid for, but she kind of declares it here, and then go anything against it that was kind of coming out of it. I hope that made sense. Right.
Magdalena, quick question. What's the what function does finding the net profit margin serve?
The net profit margin. Well, in general, your profit margin in general serves that you need to understand whether you're having too high of. So if you sell it for, you know, with a profit margin of £1, so you're only making £1 of difference. You need to understand like what that means. So if any of your sales, your expenses might go up in the future, or, you know, a supplier changes their pricing and you didn't allow enough buffer or whatever, all of a sudden your profit margin goes smaller and smaller and smaller. So you need to understand the profit margin per item or per product that you're selling, and that there is enough of a buffer. Industry-wise, it might change year to year. You might change suppliers to make them cheaper, so you have then a bigger profit margin. So profit margin is a good thing to measure how profitable you're going to be, or you are. So it's a good measure to have. Yeah. Right. Then we're going to look at, this is a super, super simple balance sheet overview. Kind of looked at it last week. So a balance sheet is literally how it needs to be a balance. So as the word said, on the one hand, you have all your assets, and these are current, non-current, or like you can also like tangible or long-term. There are different phrases for the same kind of thing. So you have, I always like to look at them more as short-term and long-term, because short-term are things that you can easily make into cash, including cash itself. And long-term are more, like I said before, the plants and machinery or your property or whatever it is. And then on the other hand, you put that against your total liabilities. And these could be, again, long-term and short-term. So if you have a long-term loan, that's obviously a long-term liability. It might be accounts payable. These are short-term liabilities that they are basically outstanding payments that you have to make to other suppliers, and that kind of thing. And then you also have your shareholder equity. Obviously, if you're a private company, the shareholders, usually you form your limited company with, you can give it 1,000 shares. I usually think of it in 100%. So you have 100 share. And if you are your own, like, if you are the sole director of your business, you own 100% of the 100 shares. If you have multiple people in your business, then you kind of have a percentage, and therefore I like the 100 shares because it just shows, or that person owns 30 shares, that person owns, it makes just things simple. But usually you don't obviously have that much share capital if you're a private limited company. You're not publicly traded or anything, so that's a very different. And then you have your retained earnings that goes onto the equity itself as well. And retained earnings are basically just profits that you keep in the company. You're not paying yourself out. You just retain, as the name says. So the formula really is assets equals liabilities and equity. Anything that the company owns equals anything that the company owes at any point in time. And yeah, here's just a quick overview of obviously the assets. That could be cash. Those are your short-term assets. Machinery, land, all of those are more long-term assets. The liabilities are any kind of debt that you have, whether that's a loan or whatever debt you might have. Accounts payable, that's the short-term debt. That is basically, like I said, you still have to pay your suppliers next month. They're due, and that's why, but at that point in time, that's shown as a debt. It's also called creditors oftentimes, so it really depends, but that's accounts payable. And then tax payable, obviously that's your tax due. So once at the end of your financial year, you run a P&L, and then you kind of calculate your taxes, and they don't show on your P&L, they just show on your balance sheet, because that's where they put the tax to be paid. But at that point in time, when you're closing your books, that tax obviously hasn't been paid. You're going to pay it probably the next month or whenever it's due. And then you also have, like I said, the equity, so the paid in capital, usually in like I said, a private limited liability company, 100 shares or whatever you started the business with. So it always has that 100 in there. If you were public, then that's obviously a whole nother ball game. I'm not too familiar in that. So please, if you do want to be a public liability company, talk to your accountant. That's obviously also at a very different stage in your business. And I'm sure by that time, you know exactly how your business runs anyways. And then your retained earnings, that's the profits that you keep in the business. Yes, but obviously I just started the workshop, so
Yeah.
anyway.
So Meg, now I think you do know the importance of our work that we are
Yes,
working
yes,
on.
Dave, I was just thinking that when you came on, I was like, I need his product. But it is still car street parking, so that's the problem, street parking.
Yeah. But even if you can see it from any part of your house, if you can mount your camera at any part of your house, then that would work.
True. Well, you need to get going and get it on the market, then I can be your first customer. Happy to be a beta phase customer.
Yeah, sure.
Anyways, all right. I hope everybody's back. If you are, just give me a thumbs up or pop in the chat that you're there. Oh, Krishna, I've got your answer. Right.
Thank you. It was a bit confusing anyways.
Yeah, no, it was, but I now found it out. So operating activities, obviously this is all on cash flow statements. So it's all cash activities, but operating ones that are related to your income side. Makes sense. So everything that goes on around your operations. Your investing activities, they are on your long-term assets. So they are the ones, the properties, investment, equipment, plants, machinery, that kind of thing. And financing activities, they are about your long-term liabilities. So that's getting debt, getting a loan, financing everything, financing your business. Hope that made it a bit more clearer. Maybe getting even a shareholder in if you're public liability, or if you have a co-founding partner or something in a private liability, then company, you might share you might bring some cash in and finance the business.
Right. So eventually there is a cash out in the process. Somehow that's part of financing.
Yeah, so it is always cash in and out activities, but in operations, it's the daily ones like we were saying. So, and they obviously affect your net profit, your profit, the bottom line of your business. Whereas the investing activities, they affect your assets, the long-term assets. So whether you buy new equipment, buy new properties, buy land, whatever. And your financing activities, they are the ones where you get money in. So you get a loan or you get another investor in or whatever. Right. Cool. I think everybody's back. So now we just quickly touch on forecasting. I did mention it before, and anybody who was obviously at last week's workshop quickly, we talked about forecasting too. So forecasting, as you saw in the little cycle around accounting in general, is a really good tool to look at the future. You look at you kind of make future predictions based on the past and the present. So anything that you might have been operating for a year, and you kind of look at what happened in the first year and you kind of make predictions for the second year. That would be forecasting. We always, even when you're a startup and you start from zero, we still recommend to do some forecasting, because you kind of understand better what are the actual expenses that you might incur, what are the actual assumptions you're going to make on how you can get some sales in. Yes, it might just be very conservative in the beginning, but you're growing and et cetera, but it's still good to set those, because that's also equally on the other side, it's the setting yourself some goals and some objectives to reach and work towards. So I would always recommend to do some forecasting, because that's super, super valuable. And how we always recommend it, or I recommend it, is always to start, if you are a startup, to start with your month zero, because that's the month where you kind of look at everything that you create, how much investments you might have received, or how much expenses you're incurring before you even start trading. So this is where, if you are, having a piece of software or having some sort of app development you need to done before you can actually launch and actually get some sales in, that would fall under your startup costs. So month zero, and I would record it in a forecasting spreadsheet kind of under month zero. And then from month one onwards, that's kind of when you start. When you start with, what kind of sales can you expect, or you kind of predicting what kind of expenses you're predicting on a month-to-month basis. And at the bottom, you always see like your opening balance and your closing balance, because that's what I said before with the cash flow. So I always do a forecasting based on cash flows, because you could also do it more or less as a P&L, because I think at the end of the day, you could have sales like incoming cash, or you could just do any kind of revenue in the top, any kind of expenses in the middle, and then you see your difference. But obviously on a cash flow, it helps you to really understand how much money you have in the bank, basically. So it's also almost like a reconciling of your bank statements as you go along in the year. So what I also recommend is to do this, like you do a forecast initially, and then when you actually start, so for example, you do your month zero, you do your first 12 months, and then when you're actually working in your business and you actually started trading, that you always, at the end of month one, at the end of month two, you always plug the real numbers in, and then make changes and predictions on your assumptions that you had initially. You kind of change, you can see some trends, you can see, oh, actually I'm operating so much higher, like I've make so much more sales than I ever expected. So maybe you can change your predictions upwards or downwards, and just kind of see how you go along. To me, that was always the most useful when I was doing this in my business, just so I can see how things are going. Also, where this comes in, if you are a seasonal business. So my wedding photography was very, very seasonal. So obviously I was super booked out and couldn't even get to the point where I serve all my inquiries. So I had to, drop some and couldn't take them on, because it's just me against, it's time against money in that kind of business. So, and unless I would have expanded and hired some other photographers under my brand, but I didn't want to do that for different reasons. But So in general, it was always between sort of May to October. I was super, super busy, and all my income basically was generated in those times. But that was really useful to do a 12-month and to really look at that, because what I'm basically generating in those seasonal months, in those summer months, had to last me throughout the rest of the year, because I probably still incurred lots of expenses because they're on a monthly basis, some of them. So therefore, I had to be sure that my cash doesn't run out in month December or January, you know? So it was kind of, or if it does, then I had to kind of think of new frugal ways, or think of new ways of creating new revenue streams. So a forecast can really be beneficial to really understand where your business currently is at, what kind of assumptions you're making, make some predictions into the future, also based on the market that you're operating in. And then you kind of plug the real numbers in and as you go along. And I think that really helps with getting so much more detailed into the numbers. You understand your numbers much better. But you also understand how the market operates. You understand your customers better. It's just, I think in general, it's a very, very good practice to do. So I can highly recommend it. Right. So, oh yeah, this was just to highlight your startup costs in month 0. And this is your actual forecast, and then put in your numbers as you go along. Right. We're now going to talk about a little bit about accounting tools. And with that, I mean sort of systems. So yes, you could do all this in a spreadsheet, and record your expenses and your sales in a spreadsheet, and then hand it all over to an accountant at the end of the year. However, if you're a sole trader, that's easily done. But if you're a limited liability company, it becomes much more difficult that way. So yes, you could still, keep your records of all your income, keep like all your invoices, keep your records of all your expenses, and just hand maybe even the receipts and incomes just that way, or, put it all in a spreadsheet and then hand it over to your accountant. But I wouldn't recommend it because you're not really doing bookkeeping. And the bookkeeping part of it all is really where you understand how you're operating from a day to day. So if you do it all only once a year, and you kind of like get out the shoebox, the cardboard box where everything is in, and just hand it over to an accountant, you pay for that, obviously quite a bit of money, especially when you're a startup where you don't have that much money. That's a lot of money out. But B, it's also, you need to get a grips with your numbers. So I would not recommend that. And very, very easy and super simple and not very, very cost effective, where you have a cost benefit, is to actually do your bookkeeping in a software. And there are tons and tons of softwares out there. You can Xerox, QuickBooks, Sage, Free Agent. There are probably also free software out there. I personally use QuickBooks, so I'm basing my experience on QuickBooks just because it's super easy. I understand it. I mean, Sage, I have some experience because I work for freelancers who work Sage. I found it a bit too rigid. I would rather than Xerox and QuickBooks are quite the same. Essentially, they all do the same. But it's just how interfaces work and all these things. So I can highly, highly recommend QuickBooks. The costs are super minimal. I mean, if you're a limited liability company, yes, they are a little bit higher. If you're a sole trader, they also have super many deals. So the first 6 months, we like half price, and then it goes up after 6 months. But I think for a sole trader, it's like 5 to 8 quid or something. It's below 10. And for a limited liability company, it's something around the 20 pound mark. So, or 25, I'm not 100% sure, but they're different. So if you're a sole trader, it's a different type, like the QuickBook interface looks different than when you're limited liability, just because on limited liability, you have double entry bookkeeping and all these different things, and it all needs to balance out and blah, 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 blah. So it's a little bit more complex. But essentially, they do the same. You record, you put your, you attach your bank account, and again, on that note, I will talk about that in best practice, but I would keep a separate bank account, even if you're a sole trader. Whether that's a private separate bank account or a business. If you're a limited liability company, you have to have a business bank account. There's no way around it. Then it's separate anyways. But I would, in general, make your life super easier, especially when you're starting out. Keep them separate. I didn't do that in the first couple of years, and it just creates a huge mess. So learn from my mistakes. I also used to do it in Excel, and I absolutely hated it. And I did it like for 4 days straight, once a year. It was horrible. And once I implemented QuickBooks, I didn't know, like, I just thought to myself, like, what a waste of my brain cells in the first few years. QuickBooks is super easy because also, again, it comes with an app and all that stuff, but you can, if you have just a receipt, you can take a snapshot and attach it to a receipt. If your bank statement is downloaded, you can literally say, oh, that's, that's business, that was business for this and that. You can put it into the right accounts. So expense accounts, say whether it's marketing expense or whatever expense it is. Or money comes in, which you can also like attach it to the invoice. So if you can even send invoices from QuickBooks directly, which makes it even easier. So it's right there. And as a reminder, it always pops up if something, if your accounts receivable are overdue, you can send reminders to clients, et cetera, et cetera. So it's just super easy to use, and it's not a lot of money for what it can do. And it runs reports. So you can also run all your reports, your profit and loss statements, your balance sheet. You can run all of the reports that we discussed on there as well, to have a look and play with for yourself, and to really not just do it once a year at the end of your financial year, but actually, run your P&L multiple times a year to just look how you're doing, and to keep evaluating, look at your profit margins, et cetera, et cetera. So it's yeah, I can just recommend it. Better than spreadsheets, because the spreadsheets, it just, makes it very complicated, and you can't run certain reports, or it would be with a manual, or you have to, I'm sure there are spreadsheets that have all the formula in, but whether then these are the correct formula and whatnot is then to be investigated. I don't know. But I just wanted to quickly, this is just a very short video on just to look a little bit inside QuickBooks. As an example, again, Xero and all the others, they look pretty much the same. And it just gives you a bit of an overview.
Welcome to QuickBooks Online. Yeah? You're in the right place to learn how QuickBooks helps you run your business efficiently by tracking your money coming in and money going out, showing you profit and loss, and categorizing your expenses. Here's a quick tour and how to get started. The dashboard is where you'll see an overview of your invoices, expenses, profit and loss, and sales. You can also see info on your bank accounts once you link them to QuickBooks. Over here, you'll find detailed info on what's going on in your business day to day. Here is where you'll categorize all your money in and money out transactions in QuickBooks. This is also where you link your bank and credit cards to QuickBooks. Linking these is a great first step for using QuickBooks. When you do, all your transactions automatically and securely come into QuickBooks, so you can see everything that's going on. Under Expenses, you'll see info on just your money out and who you have to pay. The Sales tab is all about getting paid. Once you've added some, you'll see invoices you've sent, customers, what you sell, and more. Employees is where you can manage payroll for your employees. In Reports, you can run many powerful reports that give you insights into your business. You can also set up your GST, invite your accountant to view your books, and connect apps like Receipt Bank or T-Sheets to QuickBooks. When you need to create a new transaction, like an invoice or an expense, select New, and you'll see everything you can create for customers, suppliers, and employees. Plus, you'll see a few other things you can create. The Settings menu is where you do important things, like set up your business profile, set your preferences, and then start to customize QuickBooks for your business. It's good to spend some time looking at these settings to make sure you turn on the right ones for your business. Now that you know your way around a bit, what's next is up to you. You can learn how to manage your sales, keep track of expenses, and more. We've put links to help you get started with these topics at the end of this video. And when you find something you have questions about, help is just a click away. Select the...
Right, that's basically all I wanted to show you.
Welcome to QuickBooks.
So yeah, it's just a quick overview of how a software could work. And it doesn't go into a lot of detail here because it's just a getting started picture. But I mean, there are tons and tons of tutorials on YouTube. You can have a better look at maybe all of them and just kind of decide which one you want to go with, or if you want to go with one. But I can highly recommend using, not going down the route of spreadsheets. Don't even, like, if you're starting out right now, like, don't even think about, I know it's an expense, but it is a good investment. Let me tell you, because if you start with a spreadsheet and then you want to get it like halfway through the first year of trading or whatever, it just becomes a bit of a mess and you have to spend so much more time. So if you have the time to really look into it right now, and maybe have those few, below 10 quid a month for, if you're a sole trader, or around the 20 quid mark for liability company, I would highly recommend it. Cool. Another thing that I quickly want to touch on, these are names or like terminology that you will come across. So charts of accounts is one that will always you probably will always come across. It basically just means setting up. So if you are using a software, these are more or less already there for you. You can call them maybe slightly different, or they might be called slightly different in the systems. But basically, it's just an overview, and this is just a very short overview. But this is the charts of accounts is basically just your ledger. These are the accounts that you put expenses against, that you put income against. There are asset accounts, liability accounts, equity accounts, but then there are also the revenue and expense accounts. So these are just, like I said, if you are using a software, it pretty much comes standard already in there. Some you might add, or your accountant might suggest to add here or there, one or two, but you can pretty much use it out of the box in most of the cases. So it's just something to really be mindful of, because you want to put it in the right categories to really understand your reports later on, and to kind of see where all your money is going. So if you're using a software, it actually is really nice to do your P&L on a monthly basis, for a whole 12 months, and look at your profit and loss, or your cash flows, whichever one you want to do, but do it on a monthly basis and see where most of your expenses lie, and then you can kind of make judgment calls on them. Is that actually, I think I overpaid completely on my marketing this year, or I underpaid my marketing. I didn't do any marketing advertising, because if you book it against these accounts and these categories, it makes it in your reports so much more easier to analyze where your money is going out and going in from, if that makes sense. So yeah, just wanted to mention that quickly. Any questions at this point? No? Cool. Best practices. I just wanted to mention a few. So obviously, you need to keep all your expense receipts and all your sales invoices, whether that's physical or digital. I think HMRC made a change a few years ago where they do allow it digitally, if you want to keep them digitally. But if you have expenses that, if you have a receipt, you went somewhere and you bought something on the way, and you only have your little receipt from your card payment or whatever you did, then keep that. Take a copy, maybe like I always take pictures of it or scan it, and then put it into, if you're using a software, I put it in there as well and attach it to the required expense. So every single expense I have in my bookkeeping, so in my software and QuickBooks, I have a receipt attached, whether that's an invoice. When I purchase something online and I receive an invoice, I keep a digital copy of that, attach it to my account, like in QuickBooks. But I also save everything in my cloud. So I have password protected. I have all my HMRC stuff in per year categorized in the different folders, you know, trying to be really, really organized, because you have a retention period of 6 years. So if HMRC ever audits you and wants to see all your accounts from the last 6 years, there you go. If it's then like a big shoebox or cardboard box of everything, here you go, HMRC, they will thank you. They will probably take, well, they probably, I don't know what will happen, but they probably say this is not enough, or this is not acceptable, or whatever, and you have to fine, or I have no idea. I'm just paraphrasing. I have no idea what happens. I've touched wood so far, not been audited, but that's why I'm just being really, really rigid from the beginning and really relentless, and put everything in the right folders on my cloud, and also attach it on my QuickBooks. So I have it in 2 places, but I also have physical copies for a lot of the things. I used to print out everything, but then that just became, you know, that's not environmentally friendly. So I really try to keep it all digitally now. And yeah, determine how you record how to record your invoices and expenses. So that's just to remind you that obviously you could either do it in Excel, or you can do it in a software, which obviously I highly recommend it, as I mentioned now a few times. But yeah, it just makes life so much easier. Like, don't even fall behind. Don't even just be like straight from the start. I can highly recommend it. Keep on top of your numbers. Also really, really recommend review it regularly. Like, try to make a habit of it. Schedule some reminders and schedule some time into your calendar to really work on your bookkeeping. Best is probably weekly, but that's not every time feasible, but it's probably the easiest and the quickest if you were to do it weekly, because you might not have as many transactions every week. In a month, that becomes, you know, half a day's work or something. So it's and then you kind of postpone it because you're running out of time, and all of a sudden you have 6 months to catch up on. Or you do it at the end of the year when your taxes are, you know, when you're supposed to do your tax accounts, and you spend 6 full days. Been there, done that, you know, so don't do it. And yeah, and then last but not least, separate bank accounts. I can highly recommend that. Again, if you're a limited company, you have to do it. It's a must. You are required to have a business bank account. If you're a sole trader, you're not required to have a business bank account, nor a separate bank account in general. But again, I would highly recommend doing it. You don't have to do a business bank account, which would obviously, after, I think most banks have 18 months for free, and then it costs. So what I recommend, to probably set up another private bank account with another bank, and then keep that as your business bank account, basically as a sole trader, and do it that way. As a limited, like I said, you have to have a business bank account, so you can't just do a private one or personal one. Yeah, but highly recommend it, because then all your private expenses, all your personal stuff, your rent, your whatever, your Netflix, all of that is in a completely separate account. And, you know, all your business expenses only are in one account. That is, yeah, it's just, again, I can highly recommend. I've done it the other way around. Was a sole trader. I did it all in one account. Cannot recommend it. So that's why I'm saying all of these things, learn from my mistakes. But yeah, so that's very open, me being very open and sharing, because I think that's how you learn. And, you know, I had to learn the hard way. Don't learn the hard way. Do it straight away from the beginning.
If you're at a really early stage, is it acceptable to maybe have like a Monzo account, or just like something to separate it, but not like an official sort of business account?
If you're a sole trader, you can do basically pretty much whatever you want to do. If you're a limited company, you can't. You have to have a business account. But yeah, so as long as you keep it separate some way or another, I think it's absolutely fine as a sole trader. And it just makes your life so much easier. Because then if you don't make that much sales, for example, yet, that many sales, but you have a lot of expenses, obviously you have to kind of transfer money back and forth. but or if you make a lot of sales, but obviously you don't have enough money to pay your rent or your Netflix, you then transfer money there. But still, even with those transactions, that's still keeping them separate, because in your bookkeeping, then you only have to attach, if you're using, for example, a software, you only have to attach your one bank that you're using for your business transactions. And then in there, you show all the stuff. And if there is a, you know, private withdrawal, you just book it as a private withdrawal because you're transferring money to your personal account. In a limited company, that becomes a payout of your dividends. So it's a private withdrawal. And then at the end of the tax year, my accountant looks at how much did I take out of the business, how much salary was I owed by the business, and all these things. And then we kind of put it against, and the overlap, or the one that's left over, is basically my dividends. And then I have to pay tax on the dividends. But that's limited company. And your accountant will talk you through all that. That's very, like, that's very advanced stuff. Like, in the beginning, I was like, what? But all good. It makes sense after a while. You work with it. That's why it's so important to do your bookkeeping on a regular basis, and especially talk with your accountant initially and kind of discuss all these. Also, make sure if you're using a software, one of those free apps or whatever, make sure your accountant, if you have an accountant, well, first of all, you have to get an accountant, but also make sure that they can access it, that they can work with those files, because it's all well and done and good if you have one of those apps that's for free, but then you can't really run reports or like extract out of it, or invite your accountant to look at your account for you at the end of the tax year. And then they have to do everything from scratch again, or whichever. So that's why I'm always recommending to go with one of the bigger ones. I know they are paid, but it's QuickBooks or Xero or Sage, because most of the accountancies can work with all of them. Okay, so this is just a...
Sorry, Mike, I had a question here.
Yeah.
Is it a legal requirement to have an accountant, even if you are working as a sole trader, or is it just for yourself?
No, you don't have to. I don't think so. I mean, don't paraphrase me in that. Do your research on that one. But I don't think, as a sole trader, I don't think you have to legally or have to have an accountant. If you can do your accounts yourself, but it is recommended to talk to an accountant, and maybe even pay an accountant, because there's so many accountant laws that you don't know about, and they change on a yearly basis, that you just don't recognize where you make mistakes, or where you could have saved some money, or also in an accountant perspective save money. So it's not necessarily you know, your money in and money out, that's obviously always the same, but, or like, that's what you kind of see on your bank account. But in an accountant term, some of the stuff that you can account for, so an expense that you can account for, you wouldn't even thought about it, or hadn't even thought about it.
Yeah.
So an accountant can really tell you what is allowed and what isn't, how much the personal allowance is, all of these things, how to calculate that. When I did, so my very first 3 years, I was a sole trader. And by the third year, I was confident enough to, I would have probably could have saved the money on an accountant, just because I was confident of how it works and how I have to submit stuff and how it all, like the whole system. But then I turned limited, and then the whole game changed. And so I was just like, you know what, no way. So yeah, but I would recommend to always at least talk to an accountant, have your initial kind of consultations, and then see what's recommended.
All right. Yeah. Thank you.
Cool. This is just an overview of, you know, kind of like a checklist, almost like, are you up to date with your bookkeeping? And that is, again, it makes more sense if you were to use the software in this one. So bank record conciliation is a big one. So when you have your bank connected to your hopefully your separate bank account connected to your QuickBooks or whatever, it shows all the transactions that are going on, and you can kind of, you know, yes, that's business, and that goes into, I don't know, that was marketing expense. Here's the receipt, you attach it, and off it goes into like booked against that expense account. And then every month, at the end of the month, you kind of reconcile your bank account. So you kind of look at what was the cash, the ending balance, the beginning balance of that particular month, and whether all your QuickBooks transactions that you've recorded are exactly the same. And QuickBooks does it very easily. There is a bank reconciliation tab, and it kind of shows you what you've kind of accounted for and what's maybe missing, or how much the value is that's missing. And then you kind of have to look for, where is the error? What did I miss? What did I forget? What did I overdo? So it's a really good practice to do a monthly bank reconciliation. Charts of account we kind of discussed. So obviously having a chart of account in the beginning to kind of know which ones you need to book what against. But also when you look at your bank, when you want to run reports, that it's all, you know, the asset chart of accounts is the assets, liabilities, and also your equity are all in the right place, so that the balance sheet can be run and reported on. Like I said, in the softwares, usually these are kind of box standard. You don't need to make any, or not many adjustments, so you can just use them straight out of the box. Sales pipeline, I think it's just kind of a checkbox to just make sure that you always have in front of you that, you know, you have to raise invoices for stuff, what's coming up. Yeah, just kind of keep on track on your sales, and the same with the expenses and the expense categories, just keep on track on them and kind of make sure you have the right categories you want to book stuff against. Again, in your charts of accounts, that's kind of where you can make the changes. So your expense categories, you can change the, so for example, there was one that was called computer or something. And then I used that, but then I also used one, what was it? No, it wasn't. Yeah, it was computer and IT or something. And then I made a sub account for that, which is all about software. So for example, my QuickBooks expenses go into the computer IT software or online software or whatever monthly subscription, that kind of category. So I kind of made some of those. Or for example, for traveling, I put mileage again, like as a separate account, because I always want to see how much mileage I can, or travel meals or something like that. So if you're 20, I think it used to be, I don't know whether it's still the same, but if you're 20 miles away from home and you buy lunch on a business trip, you're meeting with a client somewhere, you can account for that. Or it used to be like that. If it still isn't or is, talk to your accountant. But normally that's kind of how I used to do it. And also you get, if you have a car that you use for private and for personal and business, then and you have to make sure your insurance covers business. So that's one thing that you have to, if you want to use your car for business trips, you have to have the business section in your insurance ticked for that. But if you're using your car, track your mileage. Like I have a little mileage booklet in my car, and I always write down the mileage, and then literally at the end of the month or whatever, I put the mileage, I take a copy of a screenshot of my, or like a photo of my mileage booklet, and then I put it in QuickBooks and account. You can, I think it used to be, at least up until this year, I don't know whether it has changed, I haven't looked at the current one, it's 45p per mile. So 45 pence per mile that you can receive back basically from your business. So those are just the little things to that's why an accountant is really good, because they can tell you all of these things, at least initially. And and just look at your cash flows on a regular basis and kind of monitor what's coming in and what's going out, so you can know how your business is going. So these are just some best practices. Right, now I'm going to talk quickly about the Profit First system. So we touched briefly upon that at last week's workshop, but I'm going to go a little bit more in depth into this. So if anybody has, who's not been there last week, has heard of this, or I hope, well, if you have heard of it, then perfect. If you haven't, then it's a great system. It's basically just a book by Mike Michalowicz. It's super easy. I would highly recommend it to read it. It's a very quick read because he writes like he talks, and it's very quite like funny-ish, but it's quite it's very approachable. And it's basically a system to retain cash within your business. But it's also kind of a mindset change, because so he kind of starts off with that obviously this is more a system when you're already established. So why I'm actually including it in this workshop, even if you're not established yet, or if you haven't even started trading yet, it's something to think about straight from the get-go. Again, I implemented this, I think 3 or 4 years into my business, and it has changed the game for me. And I don't understand to this day why this system is not, like, why this book is not read at, I don't know, A-level, or whenever you have any kind of accountancy or finance or bookkeeping in any kind of courses, whether that's in high school or whether that's in university. This is a system that I think is a practical, very, very down-to-earth system that makes it so much easier to maintain and manage your money. All right, the first thing is obviously the money problems that might occur is when one of two things happen. So either the sales slow down, which is obviously very obvious, that then would a money problem occur, but also sometimes when sales speed up, and that is not so obvious, but that one is also a crucial one, because when sales speed up, you always think, and that's a human behavior, you always think, oh wow, business is booming, I can invest the money in, you know, the new equipment, the new office spaces, anything that I wanted to actually ever use this money for. And all of a sudden you're incurring debt because you're forgetting you have a credit card payment coming up, or you have your delayed, you know, your accounts payable is due in a couple of weeks, or whatever it is. So all of a sudden you're spending too much for what you kind of forgetting. Or like in my business, because it was so seasonal, I had lots and lots of sales coming in over the summer months, but then obviously nothing in the winter months, or very little in the winter months. And if I forget that's happening, and I would just, oh, amazing, you know, business is booming, I would just go out and sell, like buy stuff, and for the business, obviously, because I want to grow, but then forgetting that I don't have any money coming in maybe in a later month. So the question is really like, do you ever look at your income statement, aka your P&L, or your you know, cash flow or your balance sheet on a daily basis? No, you're not. You probably look at it, if you're really, really good, you look at it on a monthly basis, which also is very highly doubtful. You probably look at it, if you're good, you look at it on a quarterly basis, but even that is doubtful. You probably only as a, you know, looking at it, or some of them only once a year. So that is not really how, but that's how accountancy works. That's how we always like, that's how you judge a business on its health in that moment in time. And that's not really telling you a lot about how you can prevent coming into debt in the first place, you know? So, but what the system kind of says, or what is it, suggested, is that we probably look at our bank balance every single day, or at least multiple times a week. So that's what he calls bank balance accounting, because it's a natural human behavior that we kind of look at our bank balance. And like I said before, if you have a lot of sales coming in, all of a sudden you're like, ooh, amazing, you know, business is really great and I can do all these things, but you're forgetting all these like other sales that might be coming in. So it's kind of, but it's a normal human behavior. So the system, the Profit First system, is really built to work with our human behavior. It's built for humans, you know. It's not something that works on the accounting principles and theories and all that. It's literally a very practical system because we understand our human behavior. And also one thing that we always think, profit is something at the end of the bottom line. You know, you do your once a year P&L and you look at the bottom line, kind of see, oh yeah, I've done some profit. Yeah, I've been operating okay. But it's always thinking of an event. It's always an afterthought. It's not something that you actually kind of build into your operations, and you kind of not think about profit in that sense anymore. And but he says basically profit is not an event. Profit is not something that only happens at the year end. It should be something that's really like baked into our business, into the everyday transaction, every moment. And it's a habit. Building that profit from the ground up is a habit. The old school of thought is really that, you know, you want to grow, and then profit will come. You know, in 5 years' time, I'm going to be profitable. But that's what he suggests is really is not how we should operate on a daily basis. Again, on accountancy theories and accountancy terms, that's how it works, and that will always how you report stuff. But on your day-to-day, when you work with your business and you work with your finances, you have to kind of think of it in a slightly different way and focus on profit instead of revenues. So revenues, yes, they are your sales coming in, amazing, you know, but you're forgetting your expenses potentially, or and therefore you're not even thinking about profit, because you know that's like the last on your mind. But we should think of profit first, and that's why the whole system is called profit first. So the traditional accounting formula is sales minus minus expenses equals profit. And that, you know, I mean, that's, like I said, that's not going to go away. That is the traditional accounting formula. And on a P&L statement, all well and good. But again, on your day-to-day, that's not how you should be operating. So we never really focus on the bottom line. We always focus on the top line. We focus on the sales, we focus on the expenses, but we don't really look at the profit. So we always, if sales are going really, really well, we increase our expenses almost naturally, because we have the new toy that we want to buy. You know, when I was the photographer, oh, there's a new camera coming out, you know, business is booming, I'm going to buy it. And it's kind of making us blind to profit. And here's a tiny video on him. So this is Mike Karlovich.
And what I realized that moment was the formula I believed for financial success is a broken formula. It's called GAAP. Generally accepted accounting principles. It's an axiom. An axiom is this: it's a truth that we hold in our minds because everyone else is doing it. There was a time with the world when we thought the earth was the center of the universe. We all believed it because everyone else did, until we realized it was wrong. The world was flat until it was wrong. Man couldn't fly until he could. We would never leave the planet until we did. And GAP's another one of these. And the funny thing about generally accepted accounting principles, it says it's an axiom right there. Generally accepted. We just generally accept it. The formula looks like this. Sales minus expenses equals profit. Perhaps you use this formula yourself. This is how I grew my business. Sell as much as you can, incur expenses to support those sales, and then you have profit. Profit is a leftover. It's an afterthought. And for myself, how I'd run my business, and perhaps you do too, and perhaps even your life, is I'd look at my bank account every single day and see how much sales has accumulated. And then I would see what bills had piled up that I could pay, extract from my sales and pay the expenses. That's what the formula says. And then I'd look for the leftover, profit. Fortunately, there was rarely a leftover there. Never, in fact. Only when I had this big moment of selling a business or a huge customer would come in and there'd be some profit momentarily until my expenses would expand to fill it.
And that's the point. The expenses will expand to fill it because there is a law